Hi, everybody, and welcome back to yet another cracking installment of the Matt Brown Show. This is the Private Placement Perspective series where we're talking about the world of, well, as you guessed, private placements and venture capital and investing. And so with us on the line from California and in the hot seat today is Saurabh, the general partner at CerraCap Ventures. Welcome to the show.
Thank you so much for having me, Matt.
Well, it's. Have you been following the Silicon Valley Bank fallout the last couple of hours?
Wait, there's a problem at SVB? We had no idea. No, it's been very interesting. This is actually something we've been following for a couple of days right now, and it's interesting how both situations and market sentiments are defining. Really the overall push, at least in the private placement space right now. Yeah. So we're talking while things are developing, so it's rather interesting.
Yeah, by the time we get done with this, something else would have happened. I actually had two general partners cancelled just today because they're dealing with the fallout of this SVB story. So anyway, it's a rolling story. But back to you, which is why you're here. I'd love for you just to kick us off and fill our viewers in from around the world on what you guys are doing at CerraCap and how you got your start in the world of venture capital.
Sure, absolutely. I have, like with everything I do, unfortunately, in life, a very circuitous route through which I get there. So my background is actually in pure tech. Back in the day, researching on what were really earlier versions of what we now ubiquitously call AI. And back then it was called artificial neural networks, et cetera, et cetera. And then I worked across the board in tech products and services and solutions, but mostly focused on large enterprises. And then about 15 years ago or so, I made a conscious switch from what I call the technology business to the business of technology. And through that, then about 8 years ago, which is back in 2015, founded CerraCap Ventures. And at CerraCap, we're a motley crew of about 5 partners who've worked together over 15 years in building companies, right? So again, founded back in 2015, we're on our 3rd fund. And the great news is we're still as insane as the day we started this, right? Typically we invest, to get into a little bit of details on the fund, typically we invest in the seed and series A stage. Check sizes ranging for about 1 to 3 million, deploying out of the third $100 million fund.
Very, very good. So with regards to your the types of investments that you're looking to make, I know you touched on the check size. How many investments have you made to date on in this 3rd fund?
Right. So we've just started deploying out of the 3rd fund with about 2 or 3 investments in there. We've got a overall portfolio of about 30 plus investments that we've made over a period of time now.
Okay, fantastic. And are these issuers or these startups that you're looking to back, are they revenue generating? I know you said seed and Series A sort of thing, but are they revenue generating typically, or are you considering non-revenue generating issuers?
Yeah, we consider both. Revenue generating is always great, but even in certain cases, even if they're not revenue generating, but you have a mature product that's out there and it's really solving a problem. And this is actually one of the key things of our fund is we say we'll get you that revenue. Right. So we consider both revenue generating and non-revenue generating companies as well.
Okay, fantastic. That's good to know. And so what makes you guys different to other VC firms currently available to startups?
Right. And really, for me, it all revolves around the definition of value. Right. So most VC funds, in fact, all VC funds and all investors, they want to be in our what they call value-added investors. Right. So back in the day, I used to always try and figure out the word of the definition of value. And obviously, it varies from different investment firms and investors. Right. What do they qualify as value or value-added investments? And I always looked at it from a startup's perspective as well to say, the value you say, is that really value? With CerraCap, when we started it, we defined value with just one word: revenue. Okay. Said, what is the most important thing that a startup needs? And I'm talking again, early stage here, right? Of course, as you mature, your needs and requirements also evolve. But in the early stage, for us, value was defined by revenue. And going with the background that all of the partners at CerraCap have, we were like, okay, this is the one place where we are value-added investors because we drive revenue. And then we became even more specific. We don't drive revenue, air quotes intended. We bring purchase orders. Okay. So typically, once we invest in a company, their first 5 to 6 million of revenue, their first key marquee clients actually come directly through us. And we encapsulated this in our model, which we call our sales and scale model. And I've kind of grown it from there. And that's why you see across our funds, we actually invest in a lot fewer companies, right? And focus on each one of those companies to drive that revenue. Because normally for risk mitigation, how do you mitigate risk in probably one of the most highest risk sectors of early stage investing is by spreading the dollar. You should have enough companies in there to make them. There's some amazing metrics out there that show the greater the spread you have, the greater the chances of your returns. But we said that we will handle risk by actually driving revenue into our portfolio companies. And that has been, really the most consistent driver of growth for us and our funds.
So how do you do that? Because it's quite an interesting thing that you're doing, right? Because if you're driving the purchase order, so to speak, the revenue lever, then are you then working with the founders on a daily basis? Do you have your own sort of shared services team that helps with marketing and sales and data and whatever? Like, how does that operating model work for you guys?
Right, and this you've actually hit on a very, very key point. And there's we learned our lessons along the way as well. So in the initial days. Because if you look at all of the partners at CerraCap, we come with that background of enterprise sales. We come with the relationships of the CIOs, et cetera, et cetera. But as I normally put it is, a CIO never signs the check. Just knowing the CIO is not going to get you a purchase order. Do you know that guy in procurement who probably hasn't seen sunlight in about 3 weeks, but he's the guy who's actually going to sign? Do you know the chief architect who's looking at it? Do you understand how to integrate into that? So that is one, which is understanding the landscape. The second piece is then positioning these startups towards that. And initially, yes, we get hands-on. We help them position correctly in front of the buyer, right? Most of the times it also involves educating the startup and who is really your buyer. Right. So, for example, if you're in digital health and you're saying, oh, I'm only selling to, hospital chains or insurance companies, we say, have you actually looked at big box retailers who at one point were outspending the others in digital health, basically with the thought point of, if I can make you feel healthier, your basket size with me would increase. So that's another example of positioning it right, which is the second step. And then you go into the actually not just the closing of the deals today, but tomorrow as well. So yes, we will get you those initial pieces of revenue, which is the most critical part, but actually help you build that team so you can sustainably increase and build that revenue down the line. And this actually we learned it the hard way. I remember, at least in the initial funds, we were successful in getting those initial purchase orders, but then we figured out we almost became these dealers almost for the CEOs, where after that you keep calling me and saying, okay, where's my next purchase order? Where's my next purchase order? And we're like, no, okay. We got to help you build that team so you can sustain it on.
Yeah, exactly. I'm not going to help you do all of it. Give you the money and then fly the plane for you too. Here's the runway and then here's the plane.
Precisely. And that's why we figured out that we were going wrong is like, you don't want to become a dealer, almost a cocaine dealer for the CEO to drive it through. You have to look at it sustainably. So initially our model was just called sales. Now it's called sales and scale for that very reason.
Okay, well, there we go. We do secrets to scale here on the Matt Brown Show too. So,
I love it.
I'm on your page, Brad. So quickly on the economy side of things, what role do the macroeconomics play in your ability to cut checks? Like, does it influence your decision making, and to what extent does the uncertainty of a macroeconomy play on your mind?
Oh, that's a very critical question. And first off, I do have to throw one compliment at you when I was looking through the questions that, even though you're talking about VCs and private placements, you also talk about the LP angle, which I think is super critical when talking about VCs, right? Because most often people forget that VC behavior, to a large extent, not entirely, but to a large extent, is also driven by LPs and LP contracts, right? So back to your question, when looking at macroeconomics, you look at it both from an LP perspective and a VC perspective, right? And macroeconomic trends play a very large role in this, right? Both in the way LPs invest in VCs, the kind of contracts they write when LPs invest in VCs, and also the way VCs invest in startups. And certain aspects of the most obvious one is macroeconomic will directly impact your risk appetite and risk timelines, right? They will directly impact things like valuations of companies, sectors, what's hot, what's not, and most critically, exit criteria and timelines. And those exit criteria and timelines then bleed back into risk metrics, right? They're the most, I think, in our face thing, like, for example, the Ukraine war and what impact it's had on supply chain tech and ag tech, very interestingly enough. Then you have the situation in China that's driving need and valuations in the semiconductor space, right? And where you can see valuations in certain companies skyrocket, right? And what we normally say, a lot of people look at venture or early stage venture capital as, hey, macroeconomic trends, but you got to look at it long term. And we say to ignore macro when investing is like pretty much driving a car down a dark street with no headlights. You're going to be moving, but the direction and the peril is rather obvious.
Yeah.
Kind of long answer to address your macro question.
Well, firstly, thanks for pointing that out, because I think also, when to be fair, like when I started doing this series, you hear the term LP, but you don't really understand if you're not in it every day. And it's been interesting to hear the different perspectives on the role of the economy. Like some people, like comeback VC, for instance, they'll say we don't give a shit about the economy because we're backing super early stage startups, cutting 500k, 750k check. So we don't care too much. It's really about the spread of those investments. And then, like they basically said, like they got 95% of their return from 4 investments out of 100. So out of those 100 investments, 4 generated 95% of the return. So for them, they're less concerned with the economy. However, where the greatest leverage, the greatest relevance of that question is to your point, is around the role of LPs, because when they're looking at, their money and their massive amounts of cash, the economy does factor more, I would imagine, to them than it does on the general partners managing their money. Do you know what I mean? In the context of a firm. So when you talk to LPs, do you find that, or how is their appetite for venture stage risk affected when the economy is uncertain?
Right. And for that, and when we say LPs, right, there are different kinds of LPs. They're the individual investors, the high net worth and ultra high net worth investors, the family offices, and then the large institutions, right? And of course, each one looks at it very differently, right, in terms of their risk profiles, etc. But if you're looking at the large LPs, I'm talking about the big institutions, the pension plans, etc., etc. They look at it, there's an internal aspect and an external aspect. Internally, first, they look at their allocation, right? Now, VC, especially early stage VC, and then getting into an even more riskier class, emerging managers within early stage VC comes out of a specific bucket, which is normally the high risk, high returns bucket that they have, right? And then they set up specific metrics based on their internal goals, what they want to see. And alternative assets in total tends to be a smaller number for these large institutions. And then within alternative assets, high risk internal alternative assets like early stage VC is a much smaller bucket. And then they have these metrics and internal goals against which they will then evaluate these external folks, which is VCs such as ours, right? And that is why when we go out there, and of course, these LPs do massive due diligence on us. We in return also do significant amount of diligence on these LPs to say, do they align with where we as a venture capital firm want to go to, right? Because if it's an LP that says, I don't care, I want my money back in 4 years and I'm going to write a contract on it, they're not our kind of LPs. So there we also see, is there an alignment in thought? Is there an alignment in the vision and how we want to drive the VC forward, right? And another aspect about this alignment, and here's the funny part, and it's the same thing between an LP and a VC and a VC and a startup, which is it's a long-term marriage. Okay, this is a 10-year plus kind of an association. That's how an LP should and would look at a VC, and that's how a VC should and would look at the thing. So with that alignment, we see both the top of the funnel and bottom of the funnel to say, is that alignment there?
Mm. The other problem that they have is that they can't, well, it's liquidity, right? Once you put your 10 million in or whatever, or your 5 million in or your million in, like you don't get, it's not a piggy bank. You don't get to pull it out just because the markets move. You know, you take a hammering in the public markets, you shorted the wrong stock or something.
Exactly. And yeah, there are a lot of levers, you know, like there are the secondary markets and this and that for LPs. But still, at the end of the day, yes, it is it is the long-term association that you look at. And the same way the VCs look at companies as well. Yeah, you can sell your stock in a company on the secondary market or whatever else, but that's not what you went in for. Right, you went in for that long-term association, that growth, and that a mutual drive of the vision.
Yeah, absolutely. Tell me, what's the primary source of your deal flow, and what factors do you consider when making an investment or not?
Right. So first, looking at deal flow, right? It comes down to the three key things: network, and then maybe location. So we look at the network that we have, the expanded ecosystem of the network, etc. But we also work with several hotbeds of innovation, right? And such as labs and universities and other specific areas where you dig out the hidden gems. Right. So those are the areas that we look at primarily. I mean, if you look at, I'd say almost 80 to 90% of all of our, 80%, not 90, but 80% of all of our investments have come through direct involvement with our network or a direct reference from our network, or the way we work with, these large corporations and hospitals on the healthcare side, or the labs and the universities, et cetera, et cetera. So that's where we kind of source it from. Then comes the next piece, which is the evaluation. And we follow, the 6T model. And different people have different variations of the 6T model. We don't say that it's any proprietary, but coming down to the team, the theme, the technology, the timing, the topography, and the terms. Those are the 6 areas where we look at when evaluating a company. But I got to tell you, the number one and most important, and that's why it's on top, is the team, right? We have a saying internally where we say we tend to invest on the jockey, not the horse, right? Especially in the early stage side of the world. And then after that, of course, you have to look at the theme, which is what is the problem that they're trying to solve, right? How are they going about solving that problem? With what technology? Is the timing right? Is the competitive landscape right? And the other terms right?
Yeah, it's I love that, those 6 T's. That's cool. I'm going to steal that.
There you go.
Yeah, it's great to hear different ways of that VC firms look at deciding whether or not to cut a check or not. So where does it go wrong, though? I mean, I've got your portfolio up for everybody. Was there a commonality that you see if you think about the last 100 guys you said no to? Where does it go wrong for them? What's the number one mistake you see startup founders making when they come to you and they go, hey, we want $1 million or $3 million or whatever?
So there are a lot of very interesting, I'd say, errors or mistakes that founders will make. Right. So let's start with a very rosy picture that all founders are good and all companies are good. But when they come in and pitch, what are some of the biggest mistakes that they make? right? And I'm making this more subjective of when they pitch to ABC as opposed to objectively on how they look at their company or how they've defined their company. All of that's okay, especially in the early stages. But the way I look at it, funnily, I think the biggest mistake that a lot of the founders make when pitching is not diligencing or understanding the audience enough. Okay, I'll give you an example. Now, you've got, let's say, a partner or a managing partner in the room, and you got an analyst in the room, right? The managing partner might not care as much. He does care, but not as much on the smaller, minor details. But he wants to know the vision. Where are you going to go with this company? Where are you going to take it? How are you going to take it? Is your vision big enough? Is your ability big enough? Whereas the analyst is not really, and he's not paid to care that much about it, but he's going to say, okay, what do your financials look like? What does X, Y, and Z look like, right? And most people fail to make a clear distinction when pitching between fact and vision. And they overlap the two. And that's what we've seen across the board as, I think, the biggest miss of the mark when coming in and when they're pitching. And the second one is, and I'm as guilty of this as any other founder out there, which is giving short, succinct answers. Okay. And I'm like, I'd be hypocritical to say this. I never give short, succinct answers. But what we've seen, which is the CEOs who do really well in their fundraise cycles, they give short, succinct answers and then wait for the VCs or the idiot VCs to ask the follow-up questions before going into the story.
Yeah, it's a great point, right? Because I know for a fact that you're going to probably pitch like 25 venture capital firms. So knowing where it goes wrong from their perspective is really key. Like one of the things that's come out quite a lot is projections. So, projecting too big, as in like you're going to be the next unicorn or whatever, or in 2 years we're going to be $1 billion company or whatever, and I was chatting to Bruce Roberts. He's been doing this game for like 28 years and from Caravan, and he said, they've done $1.2 billion worth of placements or investments over 100 companies, and not one has met their projections.
That is true. I mean, I'll tell you, most VCs, when we look at projections, we're not really looking at the numbers that you've put up on the board. What we are looking at is your understanding of how you're going to go about meeting those numbers. I'm going to do 100 million next year. I mean, listen, we know you're not going to do 100 million next year. Come on. But I want to hear, do you have the clarity to at least try and get there? I understand the market. I understand the buyers. I understand what their wallet size look like. I understand what their behavior looks like. Okay. Even then, I know you're not going to hit that $100 million mark, but that's what I want to hear when I hear projections.
Yeah, that's a great point. It's actually really, really key. It's fine if you think that, but how are you going to do it? So that's really key, because actually then you can really see how a team thinks together.
Precisely. Yeah.
And
I don't think I've ever really paid attention to the actual numbers they put up under the projections.
Yeah. No, I get that. So when it comes to, you've cut a few checks, one or two over the years. When you think about your greatest success and failure, what was the difference? What made the difference?
Again, not to repeat myself, but I think the biggest difference was always the team, right? So I'll give you an example without naming names or anything over here, but my biggest success was with an entrepreneur who once, sat and told me, he said, Saurabh, I'm going to build $1 billion business. This is how I'm going to do it. I'm going to solve $100 billion problem and just take 1% of market share. Okay. I know it sounds silly, it sounds out there, but he had the vision to do it. He had the understanding of how to execute on that vision as well, right? And he had the drive. And my biggest failure of when I ventured, and pun intended, was into an area where I had not that much of an idea, with a team that came more from the land of corporate excellence than from the village of let's get shit done, right? And it was probably the most best governed company, but absolutely collapsed because the startup world is very different. It's not about the way you're just about the way you're structured, but the way you think and how you can get shit done. And as we expected, the company failed on a beautiful company memo on a beautiful company letterhead, but that was the good night clause.
Yeah, geez, good night clause. I love that one. Listen, so what's your advice then? If we've covered a bit here around how you evaluate investment opportunities, so what's your advice to a founder looking to raise venture capital today?
So the advice comes with a presumption of you've got the right company, you've got the right vision, you've got all of that worked out, and now you're going out into the market to raise capital, right? One of the hardest things to do. And the advice that we normally give is start with a shotgun and end with a sniper shot. Okay? If I can expand. The most important thing when raising a capital is first you have to reach enough people, but they have to be the right people. Okay? If you're one of the most amazing early stage startups, but you're pitching to, I got a meeting with the head of TPG, private equity. Yeah, it's a great guy, but it's the wrong guy, right? That's not who's going to give you the check. He'll absolutely listen to you because you're great. So evaluate your prospects, go broad enough. And then when you understand the right ones, it's a sniper shot, right? Focus on them. And to wrap it out, keep everything time bound. Right? I've seen companies that have gone on these 2-year fundraising routes, right? And yeah, listen, fundraising takes time, but do it in marked pieces. So, I'm raising 5 million right now, right? I've been in the market, hitting my head. It's been 6 months. All I've done is 1.5 million. Great. Close it. Focus on increasing those metrics. Open another, convertible note round or something else. You don't have to do it as equity. Keep it time bound as well, right? So 3 things. I said 2. I like 3 things. So start with a shotgun, end with a sniper shot. No matter what, keep everything time bound.
Really great advice. And on that bombshell, we're going to take a quick break. The Matt Brown Show, Caravan, an investment bank that offers and supports direct private investments in U.S. operating companies. Over the past 20 years, investors have placed over $1.2 billion of private debt and equity in more than 100 companies through Caravan and its affiliates. Caravan leverages technology to empower its community of investors to deploy their capital far more efficiently than ever before and connects their community of engaged investors with worthy companies. Invest portions of your portfolio in direct private investments today. Visit caravan.com/Matt Brown Show for more. And we're back. So, Saurabh, when you do cut a check and you have met the right team and they have the right problem and they, timing makes sense and the terms makes, this is really around the terms of your 6-step T framework. But what capital structure do you prefer? Like, do you go to a safe when they're pre-revenue? Do you go to a convertible like notes if they're revenue generating over $1 million? Like, walk us through how you approach defining what the deal structure should look like.
Yeah, and this is one of those well-known secrets of VCs, where they have defined structures, but if you're good enough, they'll break it for you. Although I'm sure a lot of my GP friends will probably throw something heavy at my face for me for saying that. But typically, as CerraCap, we love leading deals. Sometimes even syndicating them. We'll play the lead in the round, sit on the board, and we like to sit on the board because we're driving all of this revenue into them, et cetera, et cetera. But for the right company, or depending on the stage that those companies are at, we're happy to be a little more flexible in certain situations, right? So the company's between a seed and a Series A right now, and they're doing a convertible note. We evaluate them and we're like, you know what? We can actually help these guys. We can drive that revenue. We see the vision. I'll do that convertible note. Of course, I'll do it only with a cap and not one of those uncapped convertible notes and play in the wild, wild west. Because again, I have LPs to report back to as well. but we will be flexible for those right kind of companies. The other aspect of this that a lot of, at least folks at the who are CIOs of larger funds will also look at it is not just from a company standpoint, but from an overall portfolio construct standpoint as well. Where every time we invest on my overall portfolio construct, we see the risks that we've taken against those initial contracts, right? So let's say I'm going to invest in 10 companies. And 8 of them I've done convertible notes. So the last 2, there will be a question down to the partners to say, guys, we've already done like 8 convertible notes. Can we actually do a series round? So those are certain behind the curtain things that do impact the way that negotiation is done. But what I've also seen, at least with all of the great VCs, is they have their structures, but for the right companies, for the right founders, etc., they will, get and be flexible, and so you should.
Mm-hmm. So let's quickly talk about exits. Where do you sit on evaluating or prioritizing exits? Do you just because you said earlier, like, or a previous guy, funnily enough, was actually saying, like, my first thing is why exit now? Why does it make sense now? I've had other GPs saying, we don't, we advise, but we don't make the decision. Some are, look, we will make the decision because we, depending on the age of the fund and where we're sitting in terms of our DPI, right, and our returns for our LPs. So there's lots to consider there. Where do you fall when it comes to evaluating and prioritizing exits?
Yeah, I'll give you this old adage that I've always loved, which said that investing is a science, but exiting is the art. The reason is there are just so many parameters that get into it, right? It's the culture of the VC, the company, where it's going, the CEO, how does he look at it, the macroeconomic conditions, and several other parameters. Those all combine to form the idea on the exit, right? So first thing, I'd start with what is the cut from a CerraCap standpoint. Everybody says and should say that they're founder-friendly investors. We truly try and align our metrics to be founder-friendly investors. That is, we will work with the CEO. I'm not going to stand there and bang a gravel and say, exit, exit, exit now. That's not what early stage investors are in there for. But we also recognize that things change. The CEO's timeline could change. The market conditions could change. So how do you work with that? And then hence the art of how do you define when do we exit? But from a cultural standpoint, we don't mandate in terms of exits or anything of the sort.
And why not?
For 2 reasons. Number one, if you've gone into the company after doing all of the diligence that you did, and you probably had the CEO do cartwheels for 6 months or 3 months or whatever before you invested, you've made a commitment to the company. You also have a commitment to the LPs, 100%. And the LPs have backed you with the belief and the faith that you know what you're doing. And you've backed that portfolio company with that same belief and faith, and you know what you're doing. So we're not in there to exit in 2 days. Now, if I was a different kind of a fund, a late stage fund or something of the sort, of course, metrics will change. But from our perspective, we back that company through. Second, exits are also a very collaborative process. So, and we've done it. We've seen other GPs do this as well. That the company, you already have a 15, 20x multiple on your dollars, but the company's still growing bigger. That's when you work with the CEO and says, "Hey, how about we take a few chips off the table? So I'm happy with the 10x return. I don't want 100x or whatever. Let me take a few chips off the table, but still back you onwards, depending on the DPIs of the fund, or how much I want to return, or how, stage, life cycle, what you may have within there." So that's why I call it more of an art rather than a metric driven science to say, "This is when I'll exit. This is how I'll do it." Slap, slap, slap.
Yeah, I love that. I love that quote though, around exiting is an art, because it really is. Like, I've sold a couple of companies, and until you actually, until you've completed one, I don't think you really understand like the full breadth of what it means to be an entrepreneur, because you're so caught up in the, well, let's build a product, get a customer, get more customers, then raise some money, and then it's like, oh shit, like I got to sell this thing, and then that's a whole other monster.
Exactly.
Cool. So when you think about the world of venture capital, what keeps you up at night? Is it the portfolio performance? Is it return on your capital to your LPs? What keeps you up at night?
Well, it's always, just as entrepreneurs are building their organizations, I'm building mine, right? So CerraCap Ventures is just another organization. 8 years ago, we were just like any other startups starting out. Of course, our product is different. Our outcome is different, right? So there are the standard things that keep me up at night, which is the performance of my product, right? And the performance of my product are my portfolio companies. That's always there. The other impacts against that, what is it that I'm not seeing? But when I look at larger venture capital and I look at our next fund and how we're looking at it, the two things that, kind of keep me up. One is the mindset and the fads, right? Folks like us and in the areas, and by the way, we only invest in 3 areas, what we call the healthy, secure planet. So healthcare, cybersecurity, and planet tech in areas like ag tech, et cetera. Our biggest fear over there is, again, that mindset and fads, where there's more startups and more money that's gone into faster delivery of gourmet meals than solving real world problems. And that's a worrying trend for folks like us. We're in there to solve those large real world problems. That's what, all your cliches around disruption and innovation come from. But if most of the money is going in faster delivery of gourmet meals, you have an issue. You have an issue with the deal flow. You have an issue with mindset, all of that. And then the second piece is that constant battle between building a company and growth at all costs. And I'm not here to preach about one versus the other, this one's better, that one other, but that once taken in the right context and the right framework, it can be a good thing. And when taken in the wrong framework, a really bad thing. So those are the 3 things that, constantly keep us worried. So the first one is, the way that we're building our funds, our companies, our portfolios, and where they're going. The second one is where is the market going and the way they think. Because the first one impacts our returns. The second one impacts our deal flow. And the third one impacts both of them really, in terms of that confusion. So I think those are the things that I'm always trying to keep a very, very close watch on.
Very interesting, very insightful. Looking forward, obviously, venture capital has, well, not structurally changed, I would say, since the 1800s, but things do change. AI is real, and how do you see the sort of the venture capital industry evolving in the next 10 years, and what do you think its impact will be on founders looking to raise from VCs?
Right. And I'll make 2 controversial statements over here, or semi-controversial, that obviously, and we're seeing it, that venture capital as an industry is absolutely ripe for disruption. My thought of feeling here is that over the next, let's say, 10 years, the 2 and 20 model has to die. Okay. For some folks who don't get the 2 and 20 model, that's how VCs get paid. Or any money that we take from LPs, it's 2% is management fee, 20% is carry. Carry defined as basically we take 20% of any profits that is returned back, right? And as you said, it's in the 1800s, it's that 2 and 20 model that's gone in there. Over a period of time where things are going, we're seeing that that's also caused a lot of misalignment. That LP, VC, CEO, Portco CEO, supply chain, a lot of misalignment there. And a lot of people are trying different routes around this on how can we completely disrupt this 2 and 20 model? How can we get much stronger alignment between the LP, the VC, and the portfolio company? And for that, you almost have to reimagine both the incentive and the cash model. There is another aspect of the disruption, which is the disruption within how do VCs evaluate portfolio companies, or how does evaluation go? And that's where, AI, data-driven, quant-driven decision making comes in. It's been around in the hedge fund space since dog's ears, right? In terms of quantitative and quantitative methods, etc. Can you take those same principles down there? And yes, those all will make quite a difference. But for me, the real focus, when you talk about your question being on the evolution of venture capital, it is how do you kill the 2 and 20 model to make something way better? And it's going to happen.
When do you think that's going to happen? Because, can it happen soon?
Let's put it this way, Matt. Let's you and me work together, and we can do that in the next 2 years itself. But candidly, that's actually one area that both my team and I are working very, very deeply into seeing how you can significantly change that 2 and 20 model, but still align to all of these, larger metrics and risk factors of these LPs and how that entire cash flow occurs. So yes, that is something that we are very, very closely working on. And for me, the sooner the better.
Yeah.
But changing LP mindset, especially when you're looking at the billions and billions of dollars involved, might take a little more time. I'd want to do it in the next 2 years in itself, if I can, even with one fund, which is one of our key thought processes and drivers. And we've got a lot of people who've liked it thus far, and now moving to see if they actually put checks against it. But it's not mature enough. We have to mature that idea quite a bit more.
It's a very interesting space because, I never thought I'd be, even remotely, even talking about venture capital until I got to the States. So when I got here, I did about 170 episodes and with startups, and then this capital raise story always comes up, doesn't it? And then I got a few of them started to say, "Listen, can you help, whatever." And then that was 8 months ago, and now I'm talking to VCs and starting to see how do you actually make decisions. You start to connect the dots, and a way to summarize what you're trying to resolve, in one sense at least, is, I think it was from Adaptive VC. I'll pull up his name in a minute, but I want to get this statement out. But basically, he said his greatest fear is that he'll wake up one morning and he's cut 37 checks in the last 2 years, say 18 months. And he said his greatest fear is waking up one morning and his portfolio reflects his biases.
I love that.
Because it's literally do I like you? Do you know? Yeah. It's such a fucking ridiculous approach to. I mean, I know there's other things. You got your T6s. Others look at other things. Some back the horse, some back the jockey. Sometimes the jockey doesn't matter if they're a first-time founder. You know what I mean? So it's there's so many variables. And depending on the type of firm that you are as a venture capital firm, like Nick Cooney runs Lever VC, and they do protein transformation investments. So and even he said the same thing, different words of course, but he was also saying the same thing. He was dude, can somebody come up with a way to actually make this more systematic and technology based? Which is why I believe AI will absolutely change the VC. Someone will do it, right? So whether it's a VC firm or it's a startup who's we're tired of being told no. I mean, I my previous company, I had a group and there was some technology products, and one of the interesting things was there was a firm here in the US that apparently, okay, this was before ChatGPT was a thing and AI was cool. But where they used AI to evaluate the team piece, just the team piece. And so we filled out all the information. They were no. And that was it. I'm yeah, but why no? Can you give at least one little bit of an insight other than no? You know what I mean? So was it really AI, or was it just someone with a spreadsheet behind it?
The problem with what you've said, Matt, is you started talking AI in front of an absolute self-confessed nerd over here, right? And my background's in AI, and one of the biggest problems of AI is back explanation, right? So AI can tell you what to do, but if you ask it why it told you that, it can't answer that question, which obviously with general AI and now self-learning AI and all of that, we're trying to solve. But yeah, it will absolutely change the way we look at VC, but at least I'm talking early stage side, right? Metrics change when you look at late stage and things like that. But on the early stage side, because of the impact of the jockey on the future or the race, that interpersonal aspect will always be there. Okay, that's just my belief. Now, how you go about it, very different, right? Of course, if I had the right AI models right now, can I take my funnel and my pipeline and go through way more companies? That's like music to my ears, right? Instead of evaluating 4,000 startups a year, if I could evaluate 10,000 startups a year and have the deal flow to do it, nothing better. And I think AI will enable that, right? And or separate the wheat from the chaff as well. But I somehow feel, and maybe I'm wrong over here, but I somehow feel that right at the bottom of that funnel, it's still going to be interpersonal.
It will be. I mean, there's no data to train an AI model on. That's, you know what I mean? Like, there is no data. I have an idea and like $2,000 in revenue. That's not exactly a model you can train. But maybe you could do psychographic stuff. You know, there's a guy called Usman Sheikh, and he does this amazing. I don't know how they've done it, but anyway, you can like, it's like a
psychographic profiling for sure.
Like
for
maybe
sure.
that's a thing, you know.
But if you look at it again, if you take a step back and look at it, you know, there was a guy called Bellinger back in the 80s who defined the evolution of data in itself, and he created what was known as the BIKW model, which I always found fascinating. That is data to information to knowledge, and knowledge to wisdom. And if you see, we've actually followed that path because, you know, 60s, 70s, we had data. Then you had, you know, all of those BI tools and everything going from data to information. AI now, from BI to AI driving you from information to knowledge, and then question mark on what drives you from knowledge to wisdom. But yeah, absolutely.
Yeah, well, I can say, you know, what comes after that is we get to challenge the Klingons for interstellar domination.
Either that, or I'm listening to Skynet. You know, it's one or the other.
Probably Skynet. I'm gonna go
exactly.
Klingons. No, they'll probably just kick our ass.
Exactly.
Cool. But look, one more question, and then we'll wrap up. But so I'm going to give you the keys to the Matt Brown Show time machine. And if you could go back to yourself, like, you know, 8 years ago, no LPs, no fund, you just wanted to get into the space, what advice would you give yourself about the world of venture capital and or investing?
Well, go back and start another company, not a VC. No, I'm kidding. I love my LPs. No. No, I would say, and this is a little bit of a cliche, but still very close to my heart. I think the one advice I'd give myself is to trust my gut more, which would translate to take bigger risks. Right? And I've seen that when, you know, every VC, every investor, every CEO has to constantly self-reflect. And that for me has always been the key thing. You know, as a nerd, you always want to look at data, but as an investor, you also want to look at gut. So can you take the bigger, I should have taken the bigger risks, not just look at market ripples, but look at people. And no matter what, one more thing, always show up and greet the CEO at least once a month.
Well, look, Saurabh, thank you so much for being on the show, dude. You're a cool cat. I like what you're doing. But yeah, it's been great to have you on the show, and, you know, wishing you and your team all the best in the future. And, you know, I'm happy to chat to you about this AI project, special project thing that you're thinking about. Cause I think it's, you know, goes without saying it's needed. So
yes,
what's needed is valued. So on that, thanks for being on the show.
Thank you so much for having me, man.
Anytime. Thanks, everyone.